So if you're a complete beginner to the stock market and you just want to quickly and easily understand how we can expect and kind of predict where stocks are going to go, well, this is a video for you, and we're going to get straight into it. So to get straight into it, you can see we currently have a completely plain chart and a chart with these indicators on the right. This is how I'm firstly going to show you how to put this on your chart, and you do need Thinkorswim for this. But when you're on Thinkorswim, all you need to do is go to Studies, Edit Studies, search Standard Dev Channel, and you're going to add this 3 times. Then what you're going to do is on the first one, go to edit that, change that deviations to 1, and you can change this to whatever color you want. I personally use gold. Then we click apply, and you will see that's given us this golden line and these other ones. So all we need to do now is this second deviation. We have been given this, and we want this to be blue. At least that's how I have it in my chart. And now you can see this has changed, or you can kind of see it's changed it a bit blue below, but the reason it can't fully see that is this is still stuck on second deviation. So you're going to change that to third, make your upper and lower line green, and now you can see these two charts are the exact same. So that's all you really want to do, and you want to add that to both this chart on the left and this chart on the right. If you want to do that quickly, just go over to edit, save studies, save that whatever you want, and then you can come over to here, do studies, load, and then you can click load there, and then it will duplicate your chart onto the other side. Now you have these on both sides of the screen. You may be thinking, why do we have that? Because you're going to change one of these to a 180-day 4-hour chart, and on the right you're going to keep that as a daily, a 1 year, 1 day chart. Now you have all of this. What do you do from here? Well, this is where the simple stuff actually comes, and all you need to look at is these lines. So we kind of ignore this golden deviation and this yellowish kind of one in the middle, because those don't have too much movement happening around them. What we really want to see is this blue and green deviation, and these are known as the second and third deviations. And the reason we're paying attention to these is, if you know how standard deviation works, 95% of the data will trade within this blue deviations, and 99.7% of the data should trade within the green deviations. So knowing that, once it comes to that second or third deviation, so in this case the blue or green line, we can usually look if it's down here to buy it, and if it's coming into the upper ones, we can know we probably want to short it because it's most likely going to reverse. And so right now I'm going to give you an example where the outplay or really it hasn't played out yet. So you can see, if you're watching this in a week's or a month's time, you can see how it played out and if it was accurate. So you can see currently we're sitting on Rite Aid at $11 or $10.99. We have a second deviation on the 4-hour at $10.68. We then have this second deviation on the daily at $12.30, the third deviation at $13.30, and a final one at $15.90, or kind of $16. So seeing this, we could be looking at Rite Aid short bias, meaning we want to sell shares that we don't own to kind of play it bearish. Now, if you're a complete beginner, which I guess you are if you're watching this video, you're probably not looking to short because you don't know how to manage your trades. So instead you would use this concept, but on a long biased way. Now, how would you do that? So it would be the exact same layout as here. Once it comes into that second or third deviation, we would look to short, but instead we're looking at it to come into the second or third deviation to the downside, and we can look to buy. Now on Rite Aid there is no example, there is on the first deviation, and you can see it comes in here and it starts to bounce. However, we will go over a different stock, maybe PG, could be down at the second deviation, yes it is. And so we will go through the exact same example on what you would look for. And all you would do is, again, go to your second deviation, see where that is. You would place your support lines, and this is where we would basically expect PG to bounce. So you can see here our levels are 135, 132 and 127. This 127 didn't go low enough, so we couldn't buy it there, but we could buy this 135 and we could buy this 132, and then we can see from here, if we got an average price between these, how much upside did this trade provide to our target, and that did provide around a 9.4% upside without really having to do all that much. Now, how do you find your target using this strategy? Well, if you're like a complete beginner, very new, and you don't know how to find your targets, a good rule of thumb is either going to that next deviation, so if you're buying at the second, selling into that first deviation, or if you're looking for even more profit, but again this does add risk, then we would look for the statistical mean as our final target. So that is how we find targets. Now, how do we calculate stop losses? Because again, if you're a complete beginner, you need to know when to cut your losses. So if you're very new and you don't know how to stop losses, really a simple way you can do it is look at your potential upside. So if we're averaging in, say, 10 shares here and another 10 shares here, our average is going to be in between here with 20 shares, and we can see our potential target, if we're going to statistical mean, is around 9.5%. So in this case, to make it simple, we will say it's 10% potential profit, and knowing that, we could then go down and say, okay, where's 5%? And that would be $126. We could look at that and we could say, okay, this will be our stop. So if the price continues to sell off, once it's $126, we would look to sell and just go and look at the next trade. So again, this is a very dumbed down version, just made very simple. So if you're a complete beginner, you can understand. Start just getting used to the chart, seeing how stocks move, and as, over time you'll create more structure, you'll create more depth to your strategy. But this can be a very easy way to kind of just start off, start seeing how stocks move around these levels and understanding just really how stocks move in general. Now, I hope you enjoyed the video. If you did and you want to see a more in-depth version of this strategy, you can go to this video here.